the dream of passive income, right? That's why we do what we do, the freedom to build businesses, to create cash flow, to have lifestyle, not to work in our businesses, but maybe on our businesses and scale out and take some of that extra cash and put in other assets. I know we talk a lot about real estate here, but any assets that can generate and spin off cash or passive income is a friend of ours. So we have Fred Moskowitz, the alternative investment expert here, who has done some amazing things with it, has a book out, the topic, and I want to dive deep in there. Fred, welcome to the show today, man.
Thank you, Paul. It's great to be here.
Yeah, absolutely. Always love to host somebody from Philadelphia, the city of brotherly love.
Yes. Yes.
That gives it a good name. It lives up to the name, maybe not the reputation. But anyway, Fred. So let's dive in here, man. Just real fast, bring everybody up to speed on how you got into what you're doing. And I know you speak all over the country, and you got a lot of things happening with this alternative investment strategies that you developed and utilize. So bring us up to speed, man.
Yeah. Thank you, Paul. I'll start out by saying my main focus, my business focus and expertise is all in the area of mortgage note investing. And we can get into a little more about that throughout the interview. But let me say that, and I'm sure this will resonate with a lot of people. A lot of people like to invest in real estate. It's a powerful asset class. I love it. I think it's wonderful. And I feel that just about everyone should spend some time looking at it, at least, and considering it and seeing if it's right for you. It's a tremendous way to build wealth. If you know successful individuals in your circle of friends, family, people that you know that have generated a lot of wealth, you will often find that real estate has been a part of that in some form, right? And so here's the distinction. Real estate, a lot of people know about investing in real estate. We can talk about investing in single family houses or commercial property or multifamily apartment buildings, even vacation property and short-term rentals, very popular right now. But what about if we were to talk about investing in the paper? And what that is, it's investing in the financing, all the notes and the mortgages that are associated with all of these properties. So note investing is a very interesting part of the real estate business. And a lot of people just don't talk about it. A lot of investors, they don't pay any attention to it. Most investors, when they think of a note and a mortgage, they think about being the borrower and not as being the lender. But just imagine that through note investing, what it does is it allows you to step across the aisle and be the bank. And now you transition from being the one making the monthly payments to being the one receiving the monthly payments. And so this really adds an element of stability. It's a cash flow investment, and it allows you to really increase the predictability of your cash flow, which for a lot of investors I've found is that they lack that in their investment portfolio and all the assets they own. There's not so much predictability in income there. And so investing in debt, in notes, is a great way to do that. And there's a lot of ways we can talk about passive investing. We can talk about active investing and explore some of that today.
Yeah. Excellent. And you're right. We don't talk about that often. Our business, my business is loaning money. So we do this all the time.
You originate loans, right?
Yeah. And we hold notes and things like that too. And we have private investors, but by and large on the show and the conversations with clients is not about how they can invest in the debt, but how they can invest in the asset itself.
Yeah. And it's,
Unpack that a little bit. Yeah.
yeah, investing in the real estate itself is great, especially because you have the ability to use leverage and acquire a property for the amount of your down payment, right? Which is really great, especially when you're starting out in life. You may
Hmm.
not have all the capital to go and purchase a property in cash. So, of course, get financing, and it's a great way to build wealth, especially when you're starting out. Now, fast forward a bit, once that you've built up equity, you've created wealth in other assets like real estate and other areas, what can be really powerful is taking that equity, taking that capital and redeploying it into debt. And what it does is it really has a way of skyrocketing your rate of return when you do that. And so that's a distinction I always like to mention. And the area that I like to focus on is buying loans that exist on the secondary market, which is a little bit different than originating.
Hmm.
It's a different business. It's a different strategy. There are so many ways, so many niches within note investing, and so right in our conversation, we're already seeing that we're in the same business, but a little bit different approaches and different investment thesis as well.
Yeah, yeah. Well, so let's bring us up to speed. So you talked about sort of this progression from somebody, they go
Hmm.
into business, they're putting all their time, energy, effort, and money in that to grow it. Then they get to the point where they're pretty successful. They're spending off cash, so they want to now leverage it. Or it could be a high performing a professional as well
Yeah,
that starts investing in
absolutely.
real estate. They want to get the leverage, the tax benefits, and all that. But then further in the life cycle, you're talking about as that wealth develops, now is a good opportunity to start deploying some of that into notes. So unpack that about,
Yeah,
okay, what does that look like? I mean, you're talking to people that probably have never considered that whole idea or concept and may not even know it's a possibility.
right. So let's talk about what is note investing in general, right? It's investing in acquiring loans that are backed by real estate. You have
Hmm.
downside protection because of the
Hmm.
collateral that was pledged to secure the loan. And so it is possible for investors to buy an existing note on the secondary market.
Hmm.
And when you do that, you're stepping into the shoes of the lender. And now you are secured on title by the property and receiving monthly payments. And so that creates a cash flow stream. And that's the basis of this business. Now, there are what I like about it is that we're able to invest in notes all over the US, nationwide. It's not limited to specific market. It can be if you want, but I like the idea of diversity. So we buy loans nationwide and invest nationwide. And it gives a nice diversity to the portfolio. But the way that node investing is that we're able to quickly ramp up a portfolio and scale very large, a lot faster than it would take buying real estate and owning and managing properties. And as I said earlier, it's a great real estate investing. It's a great business. I love it. However, it's not for everyone,
Hmm.
right? I speak with many investors that are what you would call tired landlords. Maybe they were only at it for 1 year or maybe for 20, but it's a lot of work, a lot of headaches. It's profitable as well. But
Hmm.
again, it's not for everyone. And for someone that might be a busy professional, a business owner, you're focused on your business. You're focused on your profession and being the best you can be at that. And so the thought of dealing with rental properties and tenants and all of that, it might not be very appealing, or it may just not fit into your overall lifestyle. And so I always recommend look at mortgage notes, because you can scale up a portfolio. It's There's less moving parts to it. It's less hands-on. Most of the work you do is in the beginning, the due diligence and the acquiring of notes. And there's really two ways to approach this that I always talk about. When someone says, "Hey, Fred," they come to me, say, "Hey, Fred, how do I get started investing in notes?" Well, there's two ways. If you want to be an active note investor, you go out to the secondary marketplace, start buying notes, and build up a portfolio that way. And what you should do, what I always recommend, you place those loans with a loan servicing company that will manage the loans on a day-to-day basis for you. And then they'll handle collecting the payments. They'll send those payments on to the lender each month. And it just takes away a lot of the administrative burden, right? Um, but the work really is in finding the notes, building the relationships to have access to buy them, as well as managing the portfolio and keeping the capital deployed at all times, right? That's active note investing. I will say, if it's something you want to do, you should be prepared for a full-time business, because that's really what it takes to be successful. Now, if someone wants to be passive, there's another option, which is to invest in a mortgage note fund. And what is a
Mm-hmm.
fund? A mortgage note fund is structured very much like a real estate syndication is, where
Mm-hmm.
there's a offering to raise capital, and then the fund managers, they'll raise capital from multiple investors, and then they'll go out to the secondary market to buy notes with that capital. But the distinction here is now they're dealing with a bulk quantity. They're not looking at buying one or two notes. They're looking at buying 10, 20, 50, or 100 notes in one transaction,
Mm-hmm.
right? And now there's an economies of scale that come into place. They'll negotiate a better discount on buying those loans, right? Loans can be bought for less than the amount owed on them. That's the
Mm-hmm.
discount.
Right.
Uh, and so they will do that. They'll have already the systems and vendors set up in place to bring in those loans, manage the portfolio, and now the cash flow that comes in gets distributed to the investors. Now, for the investors, it's really hands-on, which makes it ideal, especially if you were maybe investing out of a retirement account. Maybe you have a self-directed IRA or 401k that you want to use retirement account capital, requiring you to be hands off from the investment. It's a
Mm-hmm.
nice fit. It really works well. And
Mm.
so those are the two ways: active, building the portfolio and managing it, or passive, which is investing in a note fund that's managed for you. And what I like about the passive approach is for you as the investor, you get to leverage the expertise, the relationships, and the access to notes that the fund managers have. And in return, you get a return on your capital, which is really nice.
Mm. Okay, so that makes sense. So to kind of sum it back up, so basically the two types of note investing is the active side, where you're finding, sourcing, buying the notes, maybe one at a time, two at a time, probably not fractional pieces of notes.
No, it'll be
And
entire, yeah, entire
and then
notes.
you or your designated third party, hopefully servicer, is going to have to receive payments and manage all that, because you
Mhm.
really are the bank in essence. So in that scenario, to your point, it's a full-time job, because you got to make sure that there's a lot of compliance and things involved with that, in
Yes,
terms of receiving
there
payments,
is.
paying out people move, and all sorts of things. So but the passive side is more like a stock fund, a bond fund, where you have a manager basically doing that at scale, and you're buying, in that case, probably fractional pieces or whatever, however much you want to put in. There might be some minimums or whatnot, but There's no day-to-day management. You're getting just a return from this fund that's more diversified than one or two notes. Clearly, could
Yeah.
be tens,
Yeah.
hundreds, thousands, or whatever.
Exactly. Exactly. It
Right.
could be hundreds or thousands of notes. Yes.
Okay. And then are there different classes, like, different credit classes of bonds or mortgage notes that, based on risk
There are.
layering and that sort of thing?
Yeah, for sure. There are so many types of notes and classifications. I like to focus on residential mortgage notes, which, if you think of your Fannie Mae, Freddie Mac definition of a residential mortgage,
Hmm.
1 to 4 unit, that's the most common. So the most notes on the secondary market are of that type. That's what I focus on. But you can also get into investing in commercial loans, whether they're office properties, retail, hospitality, all of that, office buildings. There's also notes on all kinds of debt. Any kind of debt is bought and sold and traded: unsecured debt, secured debt, aviation debt, marine debt, all construction equipment. There's no end to that. Um, and another area which is popular is there are funds that invest in hard money loans, commercial lending for real estate investors, the guys that buy a property, acquire it, renovate it, and then quickly put it back out on the market. That's another type of notes that's out there, and there are funds that's what they specialize in. A little bit more risk, but certainly they pay a higher rate of return, and so you have many options out there for sure.
So, and for our listeners who aren't familiar with capital markets and how that works, I mean, you know, thinking back to the agencies, the Fannie, Freddie, and the mortgage-backed securities, and all the secondary market, and you can take this deeper if you like, but the idea is that when someone gets a loan from a retail source, whether it's a bank or an investor or somebody, they're loaning money maybe that they have in their account. We'll call it on their balance sheet or whatnot. Sometimes they get a line of credit, but let's just
Yeah.
say they have the money. Local bank will loan you the money for that house, but then as soon as that loan closes and they fund it, they're that much less money in their account, and so
Yes.
they want to keep loaning more money. So basically, what they do is they take your loan or your note, as Fred's talking about, and then they sell it on the secondary market in a host of different mechanisms and mannerisms, the way they do it. But basically, they sell that, and then they basically then get their capital money back. They make a profit on that for selling it, and they get their money back. So then they can loan it to the next person. And
Exactly.
what you're suggesting, Fred, is this happens in basically any kind of capital investment, whether it's equipment or airplanes or yachts or
Yeah.
hard money loans, fix and flip, commercial. It's all done like that. And because of this great secondary market, it creates opportunity, because if we didn't have that, if we didn't have people like you buying these notes, then there would be limited capital available on the street for people to go build and buy and grow and expand. And it's one of the miracles of modern capitalism, isn't it?
Yeah, that's so true. And so that cycle of originating loans and then reselling them, it happens every day, and it happens at so many levels. Loans, we buy loans, acquire loans for our portfolio. They may have been sold 5, 6, 7 times prior, and we will see that in the chain of ownership in the loan, and it could go years back, and that's all part of it. It happens when it's originated. It also happens when the loan seller that's selling to me, it could be an individual investor, it might be a note fund or a hedge fund. They're selling the loan. Why? Because they want to recapitalize to get into their next deal. And so they'll
Mm-hmm.
sell the loan, and they'll probably sell it at a discount. because they need to make the transaction happen. There's some incentive there. And so there's always opportunity for investors that are well positioned in the marketplace to make the connection, connect the dots, and close on a transaction.
That's awesome. And so how does the variation in interest rates and what the Fed is doing, and how does that impact the value of the note funds and the bond funds, and specifically for what you're doing and what you see?
Yeah, there's definitely an impact to pricing. However, keep in mind that a lot of the loans we buy, they were originated multiple years ago in the past. And so they're locked into whatever the market rates were at that time. And so it does impact pricing for sure. When interest rates change drastically, the pricing is going to adjust accordingly. And so we always have to be aware of what's happening in the market and make adjustments accordingly. But if loans are being sold that are on a very low interest rate, you can expect that the discount is going to be much greater there so that the numbers work for the transaction.
Right, right. So and I was hoping you were going to get to that. So as the interest rates fluctuate, the purchase price is going to change, and so
Yeah.
that's
But usually when interest rates fluctuate, the loans you already have in your portfolio, they are what they are,
mhm,
right? They will be impacted. Of course, if you have floating rate loans, they will adjust. But a lot of times, especially on the residential side, they're fixed rate loans. And so
right.
there's no change. And it really it doesn't impact the stability of the cash flow. Because if you bought good loans with a good track record and
Mhm,
solid borrowers, they're going to continue paying on the loans. It doesn't
right.
matter if the interest rates went up or down. It doesn't matter if the property value went up or went down. People want to live in their homes no matter what. And of course, if interest rates go way down, well, the tendency is going to be stronger for property owners to refinance their loans, and then you'll get cashed out. And that's
Mhm,
that's another part of the business that it brings in, Paul. It brings in an element of randomness because
mm,
you never know when a loan is going to get paid off. It can happen at any time.
right.
And so our job as investors, very important, is we have loans getting paid off, the capital's coming back in. And so our job to be a good steward of that capital is to go out and buy new loans with it, deploy it as quickly as possible. You don't want to be sitting on idle cash as an investor
Right.
because you're not making money there. And so that's
Right.
an important thing to keep in mind.
Yeah, no, no, it's great. It's great. I had this recollection when you're talking about that, is you never know when one's going to be sold. Early in my career, I got into a business and had a speaker came in, a sales guy, and I was building a sales team, and he said, just plan on that. A third of your sales guys are quitting at any one time. A third of them are sticking with you, and a third of them are brand new. So you're always, there's always this refreshing, this turnover, and it's not that much different with bonds. You just don't know. You're buying
Yeah.
new ones, some are getting sold off, but you've got this target rate of return, right, and consistent cash flow, that you can expect. That's what you're building towards.
It is. It is exactly right. And what really helps towards establishing stability with all of this is having good systems and processes in place, right, in
Mm,
your business and how you operate and how you conduct your affairs. That really goes a long way towards towards fostering a stability in, and it could be in the midst of all kinds of chaos, right, and
right.
change and uncertainty. But you're moving forward, you're navigating towards your goals and objectives, and doing so in a successful manner.
Yeah, yeah. No, it's an interesting concept, and I know it's huge. It's never, we don't talk about it much, the behind the veil, of what's happening. But creating stable cash flow, passive, consistent, predictable cash flow, particularly as you get older, and also cash flow that is, you sort of alluded to this, this idea of real estate, that it's a tangible asset. You're not
Mhm.
buying cryptocurrency. You're not buying, the latest and greatest internet stock that has a lot of hype behind it. It's legitimate. It's people living in a house. In this particular case, if you're into residential, and they want to live there, they got to live somewhere. They're paying their mortgage, and so they're going to pay it. And no matter how much gloom and doom the media wants to put out there, people are not just going to mass just not stop paying for their loans,
Yeah.
right, and walk away. I mean,
Or not
2008
not
was an anomaly, and that was crazy. But the laws have changed, the rules have changed back in 2010 with Dodd-Frank. We're not going to have that again. We don't have those kind of crazy loans and paper out there.
yeah.
So
Yeah, that's so true. But even during these times of distress and turmoil, like you said, people still want to live in their homes. People prefer to live indoors in general, right? That's what experience tells us. And so um, there's always a desire, there's always a market for desirable housing that's quality, and people want a good place to live, raise their
yeah.
family, to live, to enjoy life. And so that really adds an element of stability.
Yeah, yeah, no, that's awesome. Well, Fred, tell us how. I know you've got a book. Talk about your book and your other resources where people, if they're like, okay, this is interesting to me, I want to learn more, I want to dig in and get connected with somebody like you that knows what you're doing, and you've been in and around this industry for quite a while.
Yeah, thank you, Paul. My book that I wrote is called The Little Green Book of Note Investing, and it provides a high level overview of the note investing business and the industry, how things work. And we take a deep dive into different areas like how to perform due diligence, how to evaluate notes, how to evaluate note funds, really the differences between active and passive investing. So that would help you to decide which is right for you. And we also spend a lot of time talking about investing out of retirement accounts, investing out of self directed IRAs or
Mhm.
401ks, or my favorite of them all, which is the Roth IRA, which is totally tax free.
Mm.
It's a great strategy because note investing, it generates tax liability. And so if you can partner that up with the tax preferred treatment in retirement accounts, can be very powerful. It really helps
Mm.
skyrocket your rate of return when you do that. So we cover a lot of these topics in the book. It's called The Little Green Book of Note Investing, and it's available on Amazon. And if anyone would like to connect with me, I always invite listeners, reach out, connect with me. I love building relationships, meeting investors. You can visit my website, which is fredmoskowitz.com. And if you prefer a little bit of an easier spelling, you can instead go to giftfromfred.com. It'll send you right to my website. And once you're there, I have a special report on note investing. I'm happy to send that out to anyone that would like to request that. And so, yeah, please visit the site, check out the book, and connect with me. I always love meeting investors and connecting with folks.
Oh, that's excellent, excellent, Fred. So it's giftfromfred.com.
Yes.
That's the easy one. I'm into the
Yeah.
easy button. Although we'll get your other website in the show notes and all that. Well, Fred, this has been fascinating. It's again, we don't have this conversation often in terms of
Mm.
like the behind the veil and the opportunities that are behind the veil. And I know that they're much bigger than we even went into today, but I think this is a great starting point for people that want
Yeah.
to look to diversify and expand and that get that passive income rolling. So I'm going to suggest it, and perhaps we can do this again in the future, or maybe pick up maybe a narrower topic here and go a little deeper on it.
Yeah, I'd love that, Paul. Thank you.
Yeah, yeah, wonderful. Look, I appreciate it. And Fred, thanks again and have an amazing day. Hey, gang, just winding down here today. Thanks for listening to the show. And as always, if you need capital to grow your business, you're looking to purchase commercial real estate or build a building or invest in commercial real estate, or you're looking to acquire a business or a competitor, or just need growth capital, we'd love to talk to you. We fund businesses all day long. Our mission is to help entrepreneurs win and to fund their businesses and fund their dreams so that they can make an impact in their community. Reach out to me today. Go to our website, click the button to schedule a 20-minute conversation, discovery call. We'll have a quick conversation, see if there's a need, see if there's a fit, and we can take it from there. The website is VPC, Victor Paul Charlie .capital. That's VPC.capital. All right, there's no .com on that. It's VPC.capital. As always, keep crushing it and hope to see you soon around here. Take care.